Hello and welcome back to Money Never Sleeps. My name is Bob Cruces from M&A Wealth. If you'd like more information about what you hear during the show, give us a call at 866-973-3627 or visit us online at mnawealth.com. And while at my website, click on the page to check out past shows and subscribe on Apple Podcasts or Spotify. During today's show, we're going to examine whether retirees should continue actively investing while enjoying their post-work lives. A Forbes article, "Here's Why You Should Continue Investing After Retirement," presents an interesting perspective. First, retirees should view themselves as long-term investors. Retirement isn't a finish line, it's a brand new chapter. Even if you retire right on schedule at 65, your journey is far from over. In fact, you may have 30 years or more of life still ahead of you. A recent study from JP Morgan, noted in the article, found that a healthy, non-smoking couple has a 46% chance that one of them will live to 95. And there's a nearly 1 in 5 chance they'll reach 100. That's not just longevity, that's an opportunity. But here's where things get tricky. When the paychecks stop and you start drawing from your savings each month, it's easy to slip into a short-term mindset. Understandably, so monthly expenses don't take a vacation in retirement. Still, this can cause many retirees to see themselves as short-term investors, even though they're often only tapping a small slice of their portfolio each year. The truth is, most retirees are still long-term investors. And there's real power in embracing that perspective. First, it gives your portfolio room to breathe, to weather downturns and bounce back over time. Just as important, it helps you stay focused on the long game, making sure your investments continue to grow and keep pace with inflation so your money works as hard as you did. Retirement may mark the end of your career, but it's also the beginning of your legacy. You should plan accordingly. The article next tells us that stocks may offer needed returns. When you're investing for the long haul, time becomes your greatest ally. Over the span of 30 years, the market has rewarded patience in a big way. Since 1977, U.S. stocks have delivered returns twice as high as ultra-conservative T-bills, according to data from Portfolio Visualizer shared in the article. And when we zoom out to 15-year rolling periods going all the way back to 1928, the story stays the same. Stocks averaged 9.80% annually, while T-bills lagged far behind at just 3.34%. That's not just a difference in numbers, it's a difference in outcomes. Now let's be honest, stocks do come with more ups and downs. During the past 50 years, their volatility, which is measured by standard deviation, was about 5 times greater than T-bills. But here's the key. If you see yourself as a long-term investor, you don't have to fear the waves. You learn to ride them. A thoughtfully built, well-diversified portfolio that you build in close partnership with a financial services professional can smooth out much of the ride. Take a classic 60-40 blend of U.S. stocks and T-bills, for instance. That mix has shown a standard deviation about 40% lower than an all-stock portfolio, meaning less turbulence without giving up the journey's rewards. The bottom line, volatility is part of the price of admission, but with a long-term mindset and the right mix of investments, it's a price well worth paying. Inflation doesn't knock on the door, and it quietly slips in and makes itself at home. For retirees, it's one of the sneakiest and most dangerous threats to long-term financial security. Over 30 years, even modest inflation can dramatically reduce your purchasing power. What seems like a small year-over-year increase in prices adds up, and fast. And sometimes inflation doesn't move quietly at all. Just look at 2022 when prices jumped sharply in a matter of months. Or think back to retirees in the late 1960s who faced the relentless inflation of the 70s and early 80s, a tough time to stretch a fixed income. So how do you protect your hard-earned savings? You make sure your money grows faster than prices rise. That means leaning into investments that historically outpace inflation. T-bills, while stable, often struggle to keep up. Stocks, on the other hand, have shown strength over time, delivering long-term growth that can help preserve your lifestyle, not just your capital. And for your bond allocation, the article explains that tools like TIPS, Treasury Inflation Protected Securities, can be a smart addition. They're designed specifically to rise with inflation, helping you maintain real purchasing power even when prices climb. In retirement, you're not just protecting your nest egg, you're protecting your freedom, your choices, and the life you've worked so hard to build. A well-balanced, inflation-aware portfolio helps you do exactly that. The article next addresses a very interesting question. How much should you invest in stocks before you retire versus after retirement? Your investment mix shouldn't stand still because your life doesn't. When you're just starting out on your journey to retirement, time is on your side. That's why younger investors, those with decades ahead of them, can often afford to lean heavily into stocks. A 90-10 split between stocks and fixed income isn't unusual, according to the article. In fact, some long-term investors go all in on stocks during their early years of saving. The article adds that even Warren Buffett, in his 2013 letter to Berkshire Hathaway shareholders, suggested a 90% stock and 10% bond allocation for long-term growth. Why? Because when you've got time, you've got room to ride out the ups and downs and capture the market's long-term gains. But as retirement draws near, and especially once it begins, it's time to shift gears. Yes, retirees are still long-term investors, but now there's a new dynamic in play: monthly withdrawals. You're no longer just growing your wealth, you're living off it. That's why many financial services professionals recommend gradually reducing stock exposure and adding more fixed income. This shift, often called a glide path, helps smooth the transition from accumulation to preservation and income. When it comes to how much you should keep in stocks during retirement, the answer isn't one size fits all, but research can help guide the way. The article explains that back in 1994, Bill Bengen, father of the 4% rule, found that portfolios holding 50% to 75% in stocks produced the most sustainable withdrawal rates over time. Why not go higher? Because history has shown us what can happen. A retiree sitting in a portfolio that's 100% stocks during a 1929-style crash could see their nest egg fall 90% in 3 years. On the flip side, going too conservative, less than 50% in stocks, can leave your portfolio vulnerable to inflation, like we saw in the 1970s. The article tells us that's why the 60-40 portfolio, a balanced blend of growth and stability, has become a classic. It aims to walk the line between risk and reward. But let's be honest, the right allocation is the one that fits your goals, your lifestyle, and your peace of mind. Because retirement isn't just about numbers, it's about confidence, freedom, and waking up each day knowing you're right where you need to be. Not every retiree needs to invest in stocks, but some may still want to. Let's say you're in a fortunate position. Social Security and a pension cover your lifestyle comfortably, and you're not relying on your portfolio for monthly income. In that case, you might reasonably choose a more conservative approach, investing primarily, or even entirely, in fixed income. And for those in the later stages of life, preserving wealth may take priority over growing it. But here's where the article gives us a twist. Those who don't need to take risks may be the best positioned to embrace it. If you can weather the market's ups and downs without needing to draw from your investments, you're in a powerful position to capture the long-term growth that stocks historically offer. In fact, over time, stocks have consistently outpaced bonds, sometimes by a wide margin. If you have any questions about your retirement magic number, your retirement strategy, or any other parts of your financial strategy, visit my website at mnawealth.com or call my office at 866-973-3627 to discuss how my team might be able to answer your questions and address your concerns. It's our goal to help you prepare for the retirement you've worked so hard for.
Disclosure: all matters discussed during the show are for informational purposes only. Opinions expressed are solely those of M&A Wealth and staff. All topics covered are believed to be from reliable sources. However, M&A Wealth makes no representations as to its accuracy or completeness. This commercial shall in no way be construed as a solicitation to sell securities or advisory services to residents where permitted. Topics should be discussed with your individual advisor prior to implementation. Advisory services offered through M&A Wealth, a registered investment advisor in the state of Texas. Insurance products and services are offered through PNC Life Insurance Agency, an affiliated company. M&A Wealth and PNC Life Insurance Agency are not affiliated with or endorsed by the Social Security Administration or any government agency.